So let's talk about markets. Let's start off the program talking about markets. As I've been saying for a long time, this market makes no sense. The stock market is so overvalued based on every historical measurement of the stock market, going all the way back to 1929. And I said it's going to end very, very badly. When that is, I could not tell you. Is it now, starting now? Who knows? But I don't like what I'm seeing in the markets. It started on Black Friday, the day after Thanksgiving, with the stock market, which usually is very, very low volume, usually tends to drift a little higher, closes at 1 p.m. It's a shortened session, and you don't usually have a whole lot of action the day after Thanksgiving. Many people take the day off, they don't pay attention to the markets and so forth, but not this Black Friday. This Black Friday, this Dow Jones Industrial Average was down 905 points, which is a major, major decline on a post-holiday trading session. Why did that happen? Well, two things. Number one, for Black Friday anyway, was the emergence of the new Omicron variant of COVID-19. And everybody got crazy. The media fanned the flames of fear, and the markets got really crazy because everybody said, uh-oh, this is the bad one. They didn't tell you that it's actually milder than the other Delta variants and everything else, but that's not important. The important thing was to shake everybody up because, people now are protesting worldwide. You got tens of thousands of people in the streets in Rome, London, Australia, New York, where people are saying, we don't want to be vaxxed. We're done with this. We're done with COVID. So they have to roll out now the new variant to scare people, and everybody's out there saying, all right, get your vaccine now, you got to do it, and you got to get your booster, even though the people who are getting COVID these days are all vaccinated, but we'll talk about that later on. We'll talk about the madness of the whole COVID narrative and the whole vaccination narrative and everything else. It's just craziness. But that's what affected the markets on Black Friday, and that's an appropriate term. Black Friday meaning the shopping day, but it was actually Black Friday in the market. Now let's keep it in perspective though. 905 points at a 36,000 Dow Jones Industrial Average is not the same as 900 points when it's 15,000, as a percent, of course. Monday, we saw a rally up 236 points, and I kind of expected it. I told you that last week when we were on the program. I wouldn't be surprised to see a rally on Monday because news was starting to come out from companies like Goldman Sachs that were saying that, from all indications, it looks like the new variant is relatively mild symptoms and goes away relatively quickly, similar to a cold, and the markets rebounded. But on Tuesday, the markets got hit bad. Down 651 points. Reason being is, again, fear of the COVID variant, fear of travel restrictions, fear of people not going on cruises, airlines, and so forth. Energy prices cracked very, very hard. One of the worst days I've seen in the oil market on Tuesday, as investors are saying, well, if the economy is going to go back into shutdown and we're going to have all kinds of restrictions, we're not going to need as much energy. There won't be as much manufacturing, there won't be as much transportation, people will be staying home again and all that kind of stuff. Couple that with Federal Reserve Chairman Jerome Powell testifying in front of Congress and stating that it's time to retire the word transitory when talking about inflation. As you recall, the Fed has been saying for almost a year now that the inflation that we're all witnessing in our lives is transitory, temporary, and due to just people, the economy waking up after being shut down for COVID. Well, it's obvious at this point, it was obvious to me, I told you right from the beginning this wasn't transitory, and the Fed is just talking it to try to calm people down and not have to raise interest rates and destroy the stock market. Well, he came out and said it's not transitory. And what that meant to stock traders was that the cocaine that's been driving the market, zero interest rates and monetary stimulus and quantitative easing and the printing of $120 billion a month and buying bonds, will be coming to an end quicker than anticipated. So we saw the stocks take a pretty good hit, down 651. I think it was down more than that earlier in the day. Very, very bad day on Wednesday. Now, the market was only down 461 points at the end of the day, but that's not the story. The story was the Dow was up over 500 points in the morning. So what you had is 1,000-point reversal in the market during the day, as traders started to worry more and more about the COVID variant and what it means. Now you're hearing every day, oh, a case was found in Washington State. Oh, a case now was found in New York. Oh, by the way, yesterday it was announced that a case was found here in New Jersey. A case. And by the way, most of these people are vaccinated that are getting this. So make sure you get your vaccination and your booster, because it really works really well. So people are getting freaked out. And of course you have the media stoking the fear. The media loves this virus. I mean, from day one, they love this fear that they can generate in people. And now they're doing the same exact thing. They reset the whole thing. You know, just when we were getting past the virus, people were just done with it. They're going about their lives. They say, we're going to have to live with this thing. It's starting to peter out. People aren't going to take the vaccine. Whoever took it, took it. Those who didn't take it aren't going to take it under any circumstance. So all of a sudden, they hit the reset button. And now the first day it was announced on that Black Friday that this new variant emerged from South Africa. They started the fear factor, and the president shut down air travel from 8 countries in South Africa, which, by the way, was considered racist when Trump did it. He's the one who said it, but then again he goes and does it. The hypocrisy is just amazing. So Thursday, market rebounds up 616 points. Friday, the market was down 300 plus points most of the day. And miraculously, in the last half hour, it rallied 200 and some points, closing only down 59 points. But was down at 1.400 points. So this volatility, these big moves up and down, and if you look at it on a chart, think about it as an EKG. You know, you see smooth runnings, and all of a sudden you see these very big ups and downs. That's a heart attack beginning to happen. And volatility like this, even volatility up, big up days, big down days are not good for the market. It shows indecision, it shows volatility in the market. So let's look at other parts of the financial markets. Bond yields. You would think that if the Fed's going to start raising interest rates, based on the testimony of Jerome Powell, who said inflation is not transitory, that interest rates would go up because the Fed's going to raise rates. Well, that didn't happen at all. As a matter of fact, the opposite happened. Interest rate on a 10-year bond dropped substantially last week. Part of it is a flight to safety, where people, when they're selling out of the stock market, are moving into the safety of bonds. That's part of it. But part of it is feeling that the economy, due to the variant and shutdowns and overreactions by politicians, will cause us to go into a recession, which would mean that the Federal Reserve would reverse their policy of starting to taper their quantitative easing. And they've said that in the past, that it's always going to be dependent on factors that come out afterwards. So they could say they're going to raise interest rates in April, and if we have a stock market decline of any significance, they're going to say we can't do that. And if any organization knows how fragile the stock market is, especially regarding interest rates, it's the Fed. So very, very interesting. We've seen a major drop in yields in the bond market, which is counterintuitive to what you would think based on the Fed's comments. Oil was hit big this past week. Now, we were at 85 about 2 weeks ago a barrel. We're at 66 now. Think about that. That is a tremendous decline in energy prices. Now, we haven't seen it at the pump yet, which I find it to be quite curious that we're seeing these big drops in energy prices, but we still see, I saw on the Parkway today, $3.54 for a regular gallon. The highest I've seen was 55, so we're a penny down. Well, I think nationwide we're down 2 cents. Oh, by the way, the White House is really touting, and the Democrats, how great it is that energy prices, gasoline prices are down 2 cents. Make sure you spend that 2 cents wisely. Another thing that was interesting this weekend, Bitcoin crashed Friday night into Saturday morning. We saw Bitcoin top out at 68,000 a month or so ago. It went down to 46,000 yesterday morning. I think right now it's 49,000. but there's a little crash, literally a crash in Bitcoin. Why was that? Because Bitcoin has been dropping, and many investors worldwide in Bitcoin are very leveraged. What does that mean? It means they borrowed money on margin to buy Bitcoin. So as Bitcoin is dropping, they're being forced to liquidate to pay the margin. And there's some rumors overnight that a big holder of Bitcoin worldwide, they don't mention who it is, was forced to sell. And we haven't seen the volatility in Bitcoin like this in a very, very long time. CoinGlass, which is one of the exchanges, I believe, said that over 410,000 crypto accounts were liquidated in the past 24 hours, totaling $2.6 billion, with the largest liquidation of one account being $27 million. So we're seeing quakes in all financial markets right now. And it's got to be telling us something. And I'm not sure what it is telling us. Now, we've seen this happen before, and then we've seen the markets rally again. Berkshire Hathaway, which is the company run by Warren Buffett, and Charlie Munger is his partner. His less known partner is Charlie Munger, an octogenarian like he is. But they've been partners going way back. And he came out and he said that markets today are crazier than they were in the late 1990s during the dot-com boom. And he says current stock markets and company valuations are out of touch with reality. He said some of the valuations we saw in the dot-com boom were higher, but overall I consider this as being even crazier than the dot-com boom, which blew up in 2000. Munger said many U.S. companies were trading 35 times earnings, making it tough for average investors to get a foothold, with valuations the most extreme he'd seen in recent history. He's not a big fan of cryptocurrencies either. He said one of his big dislikes hasn't changed, and that's cryptocurrencies, which he believes should have never been invented. China made the right decision to ban them, while the U.S. has made the wrong decision not to, he said. Maybe it's just because he's an old-timer like me and doesn't really understand that. I don't know. So the question is, are we going to get a Santa Claus rally? So what is a Santa Claus rally? You hear financial news shows and analysts come out and say, we're going to get a Santa Claus rally this year. Well, what is it? The Santa Claus rally refers to the tendency of the stock market to rally over the last few weeks of December into the new year. Now, there's a lot of theories of why this happens. Some say it's because of people are optimistic during the holiday and they go out and spend a lot of money, so we see a lot of retail spending, fueled with credit usually. Just good holiday spirit, people are in a good mood. Institutional investors are on vacation for the holiday, so they're not out there, and retail investors tend to be more optimistic, more bullish. But regardless of the reason, it's true. More than 2/3 of Decembers dating back to 1960s have resulted in positive gains in the market. But there's no guarantee on any given year. 1/3 of the time, it wasn't true. Now, if you recall 2018, 3 years ago, we had a terrible December, including the worst Christmas Eve in history, where I think the market was down 900 points. I forget exactly what it was. So just because, but I'll tell you, if you're a betting guy, right, and 2/3 of the time something does something, whether going up or down, it's a smart bet, right, to bet on the market when you have a 66 to 70% chance of being right. I'd rather bet that way than bet on a 30% chance that I'm going to be right. Since 1969, the Santa Claus rally has yielded positive returns in 34 of the past 45 holiday seasons. And you want to be a little more specific about a Santa Claus rally, they say it's the last 5 trading days of the year and the first 2 trading days of New Year's. The average cumulative return over those days is 1.4%. Now, there's something called the January effect. A lot of people say that Santa Claus rally is anticipation of the rise in stocks in January. And it's known as a January effect. Why do stocks rise in January many years? Because now people could put more money into retirement plans that they had maxed out before. So say you pay early in the year you put your money into your IRA account. Well, now it's a new year. You could start funding your IRA account again. So that money finds its way into the markets. A lot of people like to front run that and buy in December. So will we have one or not? I don't know. We watch for it. I'm pretty astounded by it when it happens. A lot of people say also that a lot of people get bonuses at the end of the year in December, so they take some of those bonuses and they invest it in the market. That's a good theory. So will there be a Santa Claus rally this year? I'm going to say no. And the reason I'm going to say no is because of what I opened the show with, telling you that we've seen increased volatility in the market now. And technically, we see sell signals all across the board. Top that off with CEOs and corporate insiders are selling their stocks at a far faster rate than we've ever seen before. Do they know something the rest of us don't? Look, if they believe that their stocks are going to be going up and there's tremendous profits to be had there, they wouldn't be selling it, right? But right now, insiders are dumping stocks like there's no tomorrow. And let me say, if there's a colossal crash coming in 2022, wouldn't it be smart to sell now? Maybe that's what's happening. So these are the richest people in the world that are selling their stocks right now. Elon Musk, we're seeing Jeff Bezos. We're seeing a lot of these big billionaires dumping tons of their stock. As of Monday, sales by insiders are up 30% from 2020 to $69 billion, and up 79% versus a 10-year average. Never before have we seen so much money being sold out of the stock market by insiders. So maybe it's the supply chain crisis, it's inflation that we haven't seen since the 1970s, rising violence in our streets, unstable political situation here and abroad, potential war coming down the line. We'll talk about that later in the program. Maybe it's the fact that, the government's borrowed trillions and trillions of dollars that we don't have. And they realize that the Federal Reserve has pumped trillions and trillions of dollars into the markets. And without that, the markets would be much lower. And if they're going to indeed slow that down, it'll be bad for stocks. We also saw a poor showing on Black Friday of certainly in-store shopping, dropped 28% compared to 2019 levels prior to COVID. We still have labor shortages. We've got a lot of bad stuff going on out there. Inflation's destroying the standard of living of many middle-class Americans, so if they have to pay more for heating their house, driving their car, there's going to be less money available to spend on other things. And now we have this new variant, Omicron. It's arrived in the United States. We're already seeing more travel restrictions, more mandates. You know what? There hasn't been one confirmed death from this variant. Not in the world. And I think the total amount of cases so far is like 300. But insiders and CEOs are selling the stocks off, and it's raising a lot of eyebrows on Wall Street. And maybe they feel that now's a good time to get out of Dodge. Another piece of news that came out Friday that's influencing stock investors. November's payroll report came out Friday. Economists were expecting something like 573,000 new jobs to be created in November. Well, they missed by a little bit. The U.S. gained a paltry 210,000 new jobs. Big disappointment. It's the lowest increase in job gains in the entire year. Now, boy, that's a big miss. When Wall Street is forecasting 573,000, you come in at 210, there's a problem. Now, it could be that, and I think this is a big part of it, you can't create jobs if people don't want them. If you don't have people out there seeking employment because they'd rather be home, they're all flush with all their stimulus and unemployment, and child care credits coming in every month. I don't care how many. There's tons of jobs available. That's not the issue. There was more than 210,000 jobs available, more like 4 million last month. But it tells you that you still have a labor problem here. This is the worst labor shortage we've had in decades, and you see it everywhere. Go to a restaurant. I'm trying to be patient when I go out to eat these days because you got to be patient. I mean, these people are doing the best they can, with the shortages that they have. And you know what? If they get too stressed because people are yelling at them and unhappy with the waitresses and everything, they're going to quit too. And you're going to have nobody to serve you. So I'm kind of an impatient person, and I'm trying to change my ways. So you got to be patient with these people. They're doing the best they can. They're overworked. Many of them are working 6 or 7 days a week, and it's not their fault that they're understaffed. And that's every industry we talk about. Every industry. And meanwhile, curiously, the jobless rate fell to 4.2% from 4.6%. And that's because they're not counting people in the workforce that aren't looking for jobs anymore. They're not considered unemployed. So those numbers drop, and they're kind of misleading. We're starting to see wages go up. Hourly payroll sharply again last month. Wages are 4.8% higher than the past year. As businesses are trying to entice people to come to work. A lot of businesses are giving bonuses for people to sign up. But 4.8%, pretty good wage gain year over year, certainly compared to the last 15, 20 years. The problem is inflation is growing much faster than that. So real wages, which is wages minus inflation, are actually contracting. So we have about 6% inflation according to the government, 4.8% year over year increase in wages. Well, that's not keeping pace. And as I said many times before, if you calculate inflation correctly, like it was in the 70s and 80s, you could double that, and you're at 12% inflation, and wages have gone up 4.8%. So what will rescue the stock market here? It'll just be the Fed backtracking again and saying that, we're going to have to hold off on our tapering and our raising interest rates because the economy isn't ready for it. Some good news out of Washington, for the markets at least, is that Congress avoided a shutdown of the government after the Senate and the House voted to extend funding until February. So what they do is they keep kicking the can down the street. It was very, very close in the House. I think it was 220 to 212 to pass it. In the Senate, it was 69 to 28. So you had much more Republican support in the Senate. And it always seems that way. It seems that you have much more Republican support for Democratic bills in the Senate than you do in the House. And I'll tell you why that is. If you're a congressman, you deal in a district that is either heavily Republican or Democrat, so you're more vulnerable than a senator who has an entire state. And you got to understand, too, the senators are around for a long time, most senators. They're part of the club. They go to the cocktail parties together and dinner together. Democrats, Republicans alike. And they don't want to shut down the government and shut down the gravy train that they've been getting rich off of their entire career. So some people are coming out, some of the Republicans, and saying, look, we can't hurt jobs, in my state. This would be bad because a lot of non-essential federal employees would be furloughed without pay. Now, when you hear government shutdown, it's not what you think. They're not going to shut down the military. They're not going to shut down the IRS. They're not going to shut down law enforcement or air traffic control. But it's the other things like national parks, museums, Smithsonian, local offices of Social Security and things like that. So now they got until February, I think it's February 8th to figure that out, what they're going to do. Just realize, too, we also have the debt ceiling to deal with. That still has not been raised. And it'll have to be raised by the end of the month, or we're going to have some real problems where we won't be able to borrow. And if you can't borrow, you can't pay your bills. Isn't that a sad state of affairs for our country? That the country would basically default on itself, not be able to pay its bills, if it can't borrow money. Imagine if your household had that problem, where you couldn't pay your bills every month unless you had credit line available to you. Obviously, you would come to a point where it's unsustainable anymore. But the problem with the government, they can keep printing money, the Fed can keep buying our bonds, funding our debt, monetizing it, destroying the US dollar, fueling inflation. And that's what gives Congress carte blanche to continue to spend money we don't have. But sooner or later, it's going to come back to bite all of us. It's already started with inflation. We're paying for it. Nothing is free. Everything has a cost. And we're paying for this excess spending by paying extra money for everything. It's a tax. In essence, Congress has raised taxes to fund deficit spending. But they didn't raise taxes in a normal, custom form. They just did it in a stealth way to inflation. And we'll see what happens as inflation accelerates. We have more inflation information on the other side of the break. Let's take a break. 732-505-1160 is the call number. My name is Lou Scatigna. You're listening to The Financial Position. Don't go away.